Would you ever use similar to a married put structure with a poor man's covered call in order to have protection? Now, what he means by that is that let's go ahead and take a look just at a married put search. I thought I saw ASML on here, the stock that we were using for Octavio when I pulled this up, but I must have been looking at the Iron Condor screen instead. Looking for a good, Hess is a good price stock. All right, so we have a Hess position here, married put that we would follow going out to 2024, a risk of 8.9% for 427 days of trading. Now, as we know, of course, the preferred married put structure, we're at least 160, 180 days out in time, 150 really. But this one's going out to 2024. Nothing wrong with going further out in time. And midpoint having a good controlled risk for 427 days, 8.5%, with the ability to do the various income methods in between to lower that initial at risk, potentially bulletproof the trade, and increase profits. Now, the married put structure looks a lot like a long call. And we don't argue that. The risk-reward profile is the same as a long call position. If I just bought the January 2024 165 call and paid maybe $1,550 for it. My maximum risk is $1,550 and I have unlimited upside. We don't argue that. Remember, on the long call, your risk is not 8.5%. It's 100% of what you put into the position. That falls into the trap of over trading, falling into the lie of leverage. You trade too many contracts on the position. Your risk is much higher than 1550. You're taking out too much of your portfolio if it goes against you. So the idea is, instead of buying this and maybe eventually selling a call as the stock moves up, what if I liked Hess and I did it more as a poor man's covered call? What if I bought a 120, for example, strike call on the position, and looked to sell maybe a 160 call against it, a poor man's covered call, giving myself some upside room? And I'll keep January 2024. Well, the stock's at 143. Yeah, 120 call. I like that. So let's go out to January 2024. We're going to use a 120 call. Not a bad price. Did I select the right January? Yes, I did. I want to give myself some upside. Let's go to standard December expiration. And let's go with the 160 call. It's pretty far away, but we'll just go ahead and do that. So this is a calendar call spread, or what some might call the poor man's covered call. Rather than buying a stock and selling the 160 call, we're buying an in-the-money call. Sorry about that. That's why that price looks so good. The 120 call is at $43 or so. Okay, so let's get that correctly. We're going to buy the 120 call. We're going to sell the December 16th 160 call. Now the maximum risk is almost 3 times what the risk was on the married put monetarily, 4,127. The maximum profit here is capped at 1,300. Still good, 31.5% if the stock's up trading at 160 at our desired date. Again, Anthony's not here, so I can't clarify the question. To me, this is a different structure. To me, the calendar call, the poor man's covered call, I use this, but I use it on higher price stocks, and I probably won't be going out to 2024. I might just be going 3 or 4 months out in time. I'm looking for leverage on a higher price stock that I don't want to use in a married put in my portfolio because of the cost basis, but I like the position and I like the premium, and I'm looking for a reasonable return, and I am neutral to bullish on it, but I'm not planning on staying in the position long term. With a married put, I'm expecting more growth. I want to go further out in time with the protective put, not only to keep my risk in single digits, which has been of great benefit during 2022, but also because I'm planning on staying in it for an extended period and continuing to look for more bullish upside and taking advantage of the different income methods. I look at them as 2 separate trades. I don't think this is a bad poor man's covered call, calendar call spread, really by any stretch of the imagination. The risk is very high compared to the married put. Now, what I'm afraid of is that Anthony was asking, look, Mike, if you would have done the married put that you saw on the married put search by buying Hess at 143 and buying the 2024 January 165 call, instead of buying the stock, why not just buy the in the money call, buy the same put you were considering, and then sell a call to generate the income? This, again, is something that we don't prefer to do. In other words, if I bought the 165 put as shown in the search, but mimic stock ownership by buying an in-the-money leap call, what I'm creating is an in-the-money long strangle position. And then when I sell a call against it, it throws this thing all out of whack. Can I still profit to the downside if the stock falls below 100? Well, yes, because it's an in-the-money strangle. But now I don't have profit to the upside because it's capped again by the sold call. Yes, if it goes above 169, we have two ways to lose. If the stock's between 103 and 144, and if the stock is above 169. Unless I had a very strong sentiment that in the next 28 days, Hess was going to stay between 144 and 169, does this structure really match a sentiment that I'd have for the underlying security? Not really. This is a very tight window, and if you had a sentiment that the stock was going to stay within this tight 15-point range, you might be better off with an iron condor position or something along those lines. Yeah, the risk might be higher on either end percentage-wise, but if that is the type of sentiment that you have, the way this profit and loss chart looks, and you have a tight window of only 15 points for Hess for the next 28 days, which isn't unreasonable by any stretch of the imagination, but you could do better with other positions potentially than this whole structure that you're looking at here. This is just a little bit too much. Now let's just take a look at this in general. The in-the-money long strangle. Substituting the stock by buying an in-the-money call and using the same in-the-money put for protection, that's doubling the risk because I have to fight the time value of the put and the time value of the call that I'm buying. Where in just the married put, the only risk is the time value of the put option. Now we're doubling because we have two time values. When you start off with an in-the-money long strangle position, to save money, only putting up $7,910 instead of $14,400 to buy the stock, plus the additional $3,600 for the put. So you have a lower cost, but look at this break even. The upper and lower break-evens don't exist till about 60 points down from where the stock is or 55 points up. This structure you're starting off with is not delta neutral to begin with. It is delta opposed, meaning you need to see a much larger movement in the stock price in one direction or the other before the gain in one option and the gain in the delta counters the loss and loss of delta on the other option. We do not also recommend using the in-the-money long strangle as a substitute for the married put structure. Is your cost basis less? Yes. Are you using leverage? Yes. That's going to increase the risk and the percentage at risk, which is opposite of the whole reason we do the married put, to control risk to single digits to put the market odds in our favor. And then as you saw, adding the short call to that caps the game, just as it kind of does in the married put position using income method number one. Yes, you can roll it and adjust it, but it gives us a structure that I don't think really meets your goals for the position, Anthony, or your targets for what you'd want to see. I use the 160 to give more upside. Again, that is a hard What is my sentiment on this profit and loss chart? It's staying in this window here of 144 to 169. Anything above that is significant loss in this direction. Reason significant, but loss I don't want to see in this direction in the middle. And then, yes, if it continues to fall probably beyond your expectations, below 103, you can start seeing profit to the downside. Really don't think that's a structure that interests you or that matches your sentiment for the underlying security. But if it does, it does. But again, if this is your tight window you expect, 144 to 169, okay, let's call it 170, there are probably better structures that you can use to maximize profit in that range if that is a confident sentiment that you have for the underlying security. Those type of things being said, let's go ahead and go back to YouTube real quick. I'm going to do a search here, and I'm going to search for 3 core principles. I have a feeling I'm going to have to redo this webinar soon. Done a lot of these. Sorry about that. That's from 11 years ago. That's 6 years ago, 5 years ago. I think I want to take a look at that one. I know there was one that was recent, but we did something a little bit different. But I'm going to take a look at this one here from 5 years ago. I'm going to click on it, but I'm going to pause the video so it's not playing in the background. Why am I showing this video? Well, this video here and other ones similar to it, common questions that are asked. But in this webinar, we look at trade comparisons that investors ask about the radioactive married put setup. All right, we all know there's different ways to skin a cat, and options give us options. So when you first see the additional married put trade, or as you've been trading it for a while, you start to think, how can I do better? Isn't this the same as a long call, but a long call would do better? Well, how can something be the same but do better? We do the analysis comparing the married put structure to just buying the call option, the out-of-the-money call, which some consider a parity trade, but by itself it is not. Why buy the stock? Just buy an in-the-money call with a put for a better trade. That's going through the analysis of the in-the-money long strangle that we just looked at for Anthony. Or if you sell a call, you've created a poor man's covered call, but then add the put you would have used for a married put position. Why do we not advocate doing that to save money and to use leverage? Because it's not the same. You don't really have a positive delta as you do with the married put with the in-the-money long strangle. You're not delta neutral, you're delta opposed, is how we like to refer to it. You need more movement in one direction or the other before you start seeing profit on the position. And couldn't you get a better price if you did it as a naked put or a calendar put spread? That's sort of related to Octavio's question. Not really. Yours was a different structure, Octavio, but this goes through that as well. These are the 3 most common comparisons we receive, and we go through each one of these in these discussions. So it's always good to question, and we're always willing to answer it. If you ever come across an idea that you think works, that's why we're here, and that's why we discuss it. But we do take on these common questions and these common comparisons and discuss, just as we kind of did this evening, why we don't do it in that fashion, why we prefer the married put structure based on the analysis and what we want to see based on our expectations. And when we try to adjust that and change the structure to say, hey, if I used a lower price and still the same expectation, wouldn't I do better? We typically don't see that. Are you using leverage where you might see a higher percentage return? Of course, monetarily. You're also taking on a higher monetary risk and a higher percentage risk, which goes against the 3 core principles: forcing an ideal size trade, the at-the-money bell curve rule, and of course, the time decay or radioactive decay line for the structure. Now, the in-the-money long strangle satisfies 2 of those. It satisfies the at-the-money bell curve rules and the time decay curve, but it doesn't force an ideal size trade because you're taking too much percentage risk on the position, and the monetary risk is sometimes double or sometimes even triple of what you'd have with a standard married put approach. So again, that's why we stick with the married put based on those expectations. Not saying that strangles aren't a useful strategy. I'm not saying that poor man's covered calls aren't a useful strategy. We're saying that if you've picked a position where you think is bullish in price and growth for long term, you want to protect it to single digits, we're going to keep that with a married put position. We'll use the strangles, we'll use the poor man's covered calls in other structures for shorter term sentiment perhaps, or on higher price stocks that maybe we can't afford to use. But combining a poor man's covered call by adding a put that you would use in the married put structure, that creates something different. It's that in the money long strangle position where you're delta opposed, and you typically need to see a larger movement in the stock in order to start realizing profits. Or if you sell the call already in the poor man's covered call and then add the put, the call caps the upside, and you'll actually see higher losses to the upside if the stock really takes off, because now you're losing on the put and you're not getting any more positive delta on the long call because it's being countered by the short call that's going to a delta of 1 as you get closer to expiration.